Good morning, everyone. You are watching a live daily market outlook for Friday, 18th of May, 2012. The deepening of the Eurozone crisis with the yesterday's announcement of downgrade of number of Spanish banks is now remains actually the main driver of the markets as single currency dips further and continues posting for fresh 4-month lows. The sterling also came under increased pressure after losing some important supports at 158 zone, while dollar yen slipped again, failing to extend its recent recovery, losing its previous support and heading towards 17.9 level. Dollar remains firm against the Swiss franc as this morning's fresh rally touched 95 level, our initial target. Dollar Canadian after break above significant resistance at 10050 now is heading higher. Clearance of 10160 and 102, our initial targets, is now looking for a further extension higher. 10245 would be the next upside target, while Aussie dollar hits its fresh yearly low this morning at 97.94 as a part of the broader strength of the US dollar that pushes the counterparts lower. The crude oil remains under pressure after some brief recovery attempts were capped just above 94 level, with the fresh low seen this morning at 91.97 on the July contract, keeping the pressure on the energies as bleak outlook from Eurozone, as well as rather negative data released recently from United States increase worries about possible lower demand for the energy worldwide. Basically, this is one of the main drivers of the crude oil in the short term. Gold is in the short-term recovery attempt. However, this is still seen as corrective action as long as standing below 1600 as our initial barrier and the expected break point, and it's poised for further losses and possibly to register another record weekly losses after today's close of the market. As mentioned, Spain's borrowing costs shoot up at yesterday's bond action, and its troubled banks suffered a double blow with shares in partly nationalized Bankia diving and 16 lenders, including the Eurozone's biggest, having their credit ratings cut. Official data confirmed Spain was back in recession, and the newspaper reported a big outflow of deposits from Bankia, but the government said it had taken a fundamental step to strengthen Spain's credibility by agreeing big budget cuts with the country's free spending regions. Moody's Investor Service cut the long-term debt and deposit ratings of the 16 Spanish banks, including Banco Santander, the Eurozone's largest, saying the government's ability to support some banks had weakened Spain's banks saddled with bad loans after a property boom collapsed lie at the heart of the Eurozone crisis, as markets fear any major rescue would strain Madrid's already stretched finances and possibly require an international bailout. So this is the top news actually from yesterday. From Greece, some rather positive news, as Greek voters are returning to the establishment parties that negotiated its bailout. A poll released yesterday showed offering potential salvation for European leaders who say a snap Greek election next month will decide whether it must quit the euro. The poll, the first conducted since talks to form government collapsed and the new election was called for June 17th, showed the conservative New Democracy Party in first place, several points ahead of the radical leftist Syriza, which has pledged to tear up the bailout. EU leaders say that without the bailout, Greece would be headed for a certain bankruptcy, and ejection from the common currency, which would sow financial destruction across the continent. The prospect Syriza would win the election has sent the euro and the markets across the continent plummeting this week. The poll released yesterday predicted the New Democracy would win 26.1% of the vote compared to 23.7% of for Syriza. This would be somehow a supportive news for Eurozone and the Euro currency. However, we need to see the results of the next month's elections in Greece and to have a more clear picture whether a disaster scenario of Greece leaving the bloc or staying inside would occur. Until then, the single currency, as I mentioned at the beginning, remains under heavy pressure, and quite a bleak outlook sees potential of further extension lower. However, this is going to be discussed in our technical part. Just a brief look at today's calendar that has doesn't have many items to be released, as shown. Just a second. The German data from Germany and data from Canada are due today. German monthly PPI for April came slightly below expectation at 0.3%, while Canadian CPI is due at 12.30 and more or less is expected to stay unchanged compared to the previous month levels. 1.9 is the yearly CPI, and the monthly at 0.3, slightly below 0.4 of the previous month, while core CPI a slight decrease is expected in the monthly release, while a yearly release of core CPI for April in Canada is remains the forecast remains the same at 1.9%. And now we're going to take a more detailed look at the major currencies and commodities and see the latest movements and the expectations for today. As the end of the week, weekly close of a number of instruments will be good indicator for the coming price action of the next week, as heavy pressure, as said, remains on euro, sterling, as well as commodities. As shown on the hourly chart, euro's brief corrective action from 2 days ago from 126.81 was firmly capped at 127.50 zone, as the descending hourly 55 days exponential moving average capped the prevented the pair actually from further recovery. And the fresh weakness initially broke to 126.66 yesterday, with this morning's low seen at 126.41. That opens way for a further extension lower and basic test of our a key target and a key medium-term support at 126.22 low of euro dollar for 2012, posted on 13th of January. Extremely negative studies on lower and larger time frames keep the current downtrend firmly in play, with some overextended conditions seen on the 4-hour chart, as well as RSI on the daily chart in the deep oversold zone might be signaling some corrective action. Yet we don't have any signals for this, and the likely scenario will be test of 126.22, and also this might open way for a broader weakness, for extension of the broader weakness of euro dollar from its 2011 peak at 149.38, as some critical points were lost, such as 128.72 low of 9th of January 2011, as well as the main bull trend line drone of 2010 low at 118.75 that was taken out at 127.54, and the pair continues to trend lower within the channel, with the break of 126.22 to open immediately 126.00 as round figure support, and the next static support is close to it, 125.86. It's a low of August 2012. That might be signaling further weakness and possible revisit of 120 and 118.75 zone, the low of 2011. 10. Some corrective action is seen facing a initial resistance at 127 and 127.50, where is also the 4-hour 20 days exponential moving average. And basically this zone for now, as the current structure sees the downside firmly in play, and the heavy pressure on the single currency does not see any more significant upside action. This should be capping. Only the gain of 129 zone that is seen as a short-term break point would ease the current bear pressure and provide some relief for the pair. However, the current situation sees more potential towards the downside, and 126.22 remains as our main short-term target. Similar to euro, the cable dipped, losing some very important support, basically accelerated losses on of a corrective pullback of 163.00 peak of 30th of April 2012. Acceleration occurred after breaking below main bull trend line of 152.33 low of 2012. That was at 160.26, and then break below 55.90, and more significant 200 days moving average that was at 158.25, as well as loss of 158 higher platform and strong support with the brief break below 50% retracement of January to May, 152.33, 163.00 ascent keeps the bears now fully in play, as the studies on the daily chart broke below their midlines and see potential for a further weakness. Our next targets are at 157.00 as round figure support, and more significant are the lows of February 2012 the consolidation range floor at 156.40.50 zone, where is also the 61.8 Fibonacci retracement of 152.33 to 163.00, ahead of the most significant 156.00 higher low of 12th of March 2012, a loss of which is definitely to open way for a further weakness and keep the upside well protected for now. On the weekly chart, weakness is the positive tone of 152.33 is still in play. However, it's now been dented after upside rejection at 163, with the narrowing range creating the longer term triangle, but seeing still a potential for a further extension lower, with the targets as set 157, 157.40.50 and 156.40.50 and 156.00 seen in the short term. Immediate resistance is at 158.30 zone, where it's 220 days exponential moving average, and the static support highs of yesterday's intraday highs, while only the gain of 160 would provide a short-term relief for the pair. The dollar yen lost ground after a corrective attempt from a 79.42 low of 9th of May, failed on approach to strong barrier at 80.60 that also marks Fibonacci level. 80.54 was seen ahead of pullback that basically accelerated losses on break below briefly broken main bear trend line, as well as 55 and 20 days moving averages, and psychological support at 80.00, with sharp fall seen yesterday down to 79.12 that also broke the previous support at 79.42. This brings back short-term bears of yearly peak at 84.17 in play, as break above main bear trend line has proved to be false, as well as a brief attempt above 90 days moving average also as a false break, and the pair is back now in the firm downtrend of 84.17, 15th of March 2012 low, currently testing a 61.8% retracement of broader 7600 to 8417 rally, and the break of which would open way towards 78.48. Next dynamic support, 200 days moving average ahead of range of December 2011 at range top at of December 2011 at 78.30. Negative tone continues to dominate on the larger and lower time frames, with some overextended conditions seen on the hourly chart, suggesting some minor correction. As long as 80.00, 79.90 and 80.00 stay intact, the downside remains firmly in play, while only lift above 80.00 would ease the current bear pressure and open way for possible recovery towards 80.54, 80.60, our upside barriers that capped recent recovery attempts. However, for now, the negative tone continues to dominate, and 79 is seen as our next target, as the market already touched levels close to this level, and 78.45 and 78.30 seen as next downside target. Overnight's peak at 79.44, along with the 20 days exponential moving average at 79.48, offer initial resistance ahead of a more significant, as said, 79.90 and 80.00 that are expected for now to cap stronger upside attempts. The dollar Swiss remains in a strong rally of higher low at 90.41, higher low of 1st of May 2012, with break of significant barrier at 93.30 that marked the peak of 15th of March, as well as 61.8% retracement of broader down move from January 2012 95.93 peak to end of February yearly low at 89.30, and clearance of 94.00 continues to head south. 95 was touched this morning, our initial target on the upside, with the positive tone seen on the all time frames, keeping the upside favored. 95.45 is seen as next target on firm break above 95. This is the peak of December 2011, ahead of our key barrier and the target on the upside 95.93, high of 2011, posted on 9th of January 2012. Overextended conditions on the 4-hour chart see some potential for corrective action, with the 94.20 2 days ago, 16 and 17 May higher platform, as well as 20 days exponential moving average are offering initial support ahead of 94.00 as round figure support, while only loss of 93.20, 93 level would be harmful for the near-term structure, and then would put bulls on hold. For now, as said, initial 94.20, 94.00. Ideally, these levels should be containing any corrective dips, but as the daily studies are also, daily RSI is also in the overbought territory, some stronger correction is not ruled out at this point, and 93.40 as dynamic support, 55 days exponential moving average, 93.24 as 93.30 as a previous peak, and 93.24 38.2% retracement should be containing dips in order to keep the short-term bulls intact for attempt higher, and the test of 95.45 and 95.43 our initial targets. As I mentioned in the introduction, the crude oil came again under pressure after a brief corrective attempt seen in past 2 days of 92.16 low of 16th of May, with the upside being capped around the 94.50 level, and the fresh weakness has seen the dip to the levels briefly below 92, 91, 97 was the low of this morning. Overall negative tone keeps the downside favored for now, as shown on daily chart, as the pair broke, as the oil price, broke below 200 days moving average at 96.37 and our initial target at 92.70. Now looking for extension lower with the next significant level, very strong support at 74.94, low of 2011, posted on 2nd of October 2011. As the pair so far retraced over 50% of the initial rally from 74.94 to 110.53. More focus is seen towards the downside, as well as a brief break below the support at 792.70. Now opens way for initially towards 90.57 peak of 11th of September 2011. From the fundamental side, comments from Saudi Arabia a couple of days ago, I think we mentioned it in our earlier sessions, that ideal oil price would be around $100 per barrel, and the comments of a number of analysts that are following the energy prices see potential of a fresh build-up of the oil price, despite quite negative tone that dictates a current negative outlook for the oil in the recent sharp decline and the heavy losses that oil price suffered. However, this would be, I would say, more political question, and once the base is established, we might expect oil price to go back again, as the top oil producer wants level at $100 per barrel, seeing as ideal for them, with the production being at satisfactory levels and showing no shortage in the oil market, despite current tough sanctions towards Iran. That is one of the main supporters for a number of Europe countries, as well as top supporter for the Asian countries that all implemented the sanctions dictated by US and the Eurozone. We'll be following the oil price action and see whether this predictions would be materializing, or the oil price will continue to travel lower, as fears of lower demands and slowdown in number of world big economies are signaling a possible further decline in the demand for the energy. The yellow metal is still in the short-term corrective action of its recent low at 15.26 posted 2 days ago, when the gold dipped slightly below our next very significant support and the double bottom of 15.22, 15.32, with 15.26 seen so far. A brief break lower and a bounce, sharp bounce higher was basically expected thing, and as the giving up of such a strong support is not expected to be done at the first attempt. Initial rally has so far reached 1580 zone, just ahead of 38.2% retracement of the recent down leg from 1671 down to 1526, with the more significant barrier standing at 1600 level, previous high of 10th of May 2012, as well as 50% retracement, and basically only break above this level would provide a short-term relief and avert immediate risk of further losses, and break below 1532.22 support, and also 1500 as psychological support. For now, the improving studies on the 4-hour chart and a quite positive outlook on the hourly one sees potential of further extension higher, and as said, we need to see the regain of 16 00 level as our reference for a further extension higher. Otherwise, the likely scenario would be lower top and fresh weakness as a negative tone continues to drive yellow metal from its recent peak at 1790. This is the high of 2012 that dipped so far to 1526, and negative technicals on the larger time frames also keep the downside favored for now. And a brief look at some crosses that are also interesting at this point. Aussie dollar remains in the very strong downtrend against US dollar after descent from 108.55, yearly high posted on 29th of February, broke below 200 days moving average, and another significant support 102.25. April's consolidative range floor, accelerating losses through our next targets on the downside, 98.80 and 98.60, with 97.94. Brief break below figure support at 98.00 seen so far, and route to our next target at 96.62, low of 2011, 23rd of November. This would be the target as studies are firmly negative, but overextended conditions and oversold situation now sees potential of for some corrective action. Initial resistance is the previous low at 98.69 of 16th of May, along with the dynamic 99.21 200 days exponential moving average, and the 99.63 that are offering initial resistance on the upside. I would say a regain of parity level, and where is also the 55 days exponential moving average, and the 38.2% retracement at 10050 would provide near-term relief and allow for some stronger corrective action. Until then, the focus, however, this would still be seen as corrective, as the strong downtrend remains intact for now, and any action higher is seen so far as corrective and selling opportunity. And a brief look at dollar Canada, that, as mentioned in the introduction, broke above some significant barriers. 10050 after breaking above parity level. 10050 was the recent range top and the 200 days moving average that the pair cleared. Also the break above 101 and 101.60, 50% retracement of the down move from 105.21 down to 197.98. Now heading towards 102.45 with the brief break above 102 barrier, hitting 102.25, approaching 61.8% retracement, break of which to open way for further extension higher, and 103, 103.17 seen as the next targets. Some corrective action might be seen now, and already the pair is already pulling lower as overextended near-term studies see potential for corrective action preceding actually fresh rally. Previous resistance at 10061 is now acting as good support, along with the 101 parity level, 101, pardon, where is also the 20 days exponential moving average. Basically, ideally, reversal above 10060 would keep the short-term bullish structure of 98.00 intact for fresh extension higher. That was all for today. I would like to thank you all for attending our live sessions. Just to say to be quite careful with today's trading, as further turmoil in the markets would be likely, according to the current situation and the recent news released, as also is today's is end of the week, when a number of investors would be clearing their positions, and that might cause some opposite direction, stronger movements. We are back at the beginning of next week on Monday at the same time at 7:00 GMT. Until then, I wish you a nice day and a nice and relaxing weekend. Good luck.